Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
There are decades when nothing happens, and there are weeks when decades happen. Let me repeat that. There are decades when nothing happens, and then there are weeks when decades happen. That quote, folks, was from Vladimir, Vlad, as people on the inside know him, Lenin, Marx's buddy. And he is absolutely right. I got this email, this quote, with a mailbag note saying, this is a couple weeks ago, I've been out for a few weeks, and I want to thank Don and the team for covering for me 2 weeks ago, and we gave the team an Easter break last week because they did such a good job at protecting clients' money. I figured they worked their butts off. They deserved a break, so Don and I gave the team a break. But in any event, this was a comment from the mailbag a couple of weeks ago. Since I wasn't here, I didn't get to read it. And I loved that quote. And below that quote that says, there's weeks when decades happen, the client said, I am so happy I've got Revere watching my wealth. Folks, if you hadn't been paying attention, about a few months ago, we'll talk about that, the whole market kind of, fell apart a little bit. We actually had a bear market in the S&P, very short-lived, very, very, very short-lived, but the NASDAQ actually hit a bear market. In any event, that is what happened, and that's why he said that. Now, again, I trust everybody had a happy Easter, and I want to thank Don for running the team. We're going to dive into it, but here's what I want to ask you, folks, because I love how the pie charts are us crowd, that is the sell side Wall Street, where they take your money and they diversify it, and they buy some little treasury bonds, California muni bonds, tech stocks, emerging markets, Europe, and they make it, you're the diversifier for their pie chart or us portfolio, and they buy you a bunch of rotten fruit along with good fruit for a balanced portfolio. That's the plan. Anyway, every time and so they make an average 6, 7, 8% return, but you got to go with 35% drawdowns every 4 or 5 years. You experience that, probably, right? Anyway, every time we have a bear market, or right during that bear market, or when the market, wets the bed, you get all these articles coming out to us advisors on how to help manage client expectations. And I'm going to give you just sorry, Sas laughing, I couldn't help it. I just, whenever I do those things on Wall Street, I think about Morgan Stanley with the mahogany walls, or Merrill Lynch with the bowl. Anyway, so I got these articles. I'm just going to read you the title. They're in the show notes. You can go read them yourself. And then I'm just going to hit a few highlights of it. But here's one article title: Clients won't admit it, but here's what they need from advisors. And they're kind of talking about the hand holding, give them confidence, soothe their nerves. Here's an idea: sell before it goes down and gets clobbered. Then they'll like you, actually. Okay. As bear markets loom, advisors turn to survival tactics. And again, it's the same, comfort your client, let them know it's the long-term goals, and focus. Don't focus on the short term. Don't focus that you just lost 25% in 2 weeks and the market always comes back. And then Franklin urges advisors to ensure maximum Social Security for clients. Translation: we lost money in pie charts or else, so you need to keep working for your maximum benefit. So keep working, get that Social Security benefit up. And where is the last one? You can't outtrade tariffs as stocks move in tandem. My question is, are they unaware of the benefits of Revere to smooth out returns? Folks, there's a thing called sequence of returns. Google it. It's very important, because that story about the pie charts are us compounding on average 8% return at the end of the day at 65 or 67 now, you retired and you got the $1 million at the end of this 35 years, right? Now they're finding out with new studies, you either got $1 million or $500,000. The variance is huge. It's not 10 or 15%, it's 50%. Because the order in which the returns come out. So if you're buy and hold, your outcome is random. That's what the new modern portfolio theory shows. They don't like you to tell you that. All right, anyway. So I got the mailbag here. This is from 424 MB. Also interesting perspective on the current trading environment. A rules-based sell strategy definitely evens out the swings. He's talking about us. This guy posts this on social media. And he basically said this is an interesting perspective, and it was talking about how to short the markets, and he put it in there. And this is me. This is nationwide. It says if tariffs cause some sort of catastrophic pullback in consumer spending, everything we have modeled for doesn't work anymore. So if there's a huge pullback in consumer spending, he doesn't know what to do. One word, sell. I don't understand why these guys have such a hard time with this. Anyway, he admitted they had no plans for the market meltdown, no Armageddon scenario, no plan for the worst and hope for the best. Just stay the course. Even if the market melts down, again, just push a button. Okay, look, remember, if they had gotten defensive before you lost double digits, right? It's just an easier way. It makes it a simpler way to invest. All right, let's go to the next one. This is posted. This is actually a guy posted this on X. My professional investment advisors often have a different paradigm. Talking about Revere. Here's what mine was saying February 25th, 2025. And he linked the podcast link, Time to Short Stocks. That was the title of our podcast on February 25th. You can go look it up. We archive everything. Anyway, he said, I believe they were down less than 10%. It was about 8, while the NASDAQ was down more than 20. The S&P actually hit 20 intraday. And I made the comment, he put Revere works to protect the downside. They started selling before the general market rolled over. Thanks, Don and Dan, for protecting some of my retirement funds. Folks, I want to explain that because it's almost accurate. So we've got about half the portfolio that has leading stocks, the best of the best, right? The best stocks that are showing the best attributes. Those leading stocks, not only do they lead on the way up, that's why definition they're called leading stocks, they also lead on the way down, so they roll over first. So as the market's getting toppy and starting to roll over, leading stocks based on their own sell rules will get taken out generally first. Not all of them, but some of them. So as the market's rolling over, some of our stocks will start getting sold early because they're the earliest to trigger, to roll over. And so we've actually raised 20 or 30% cash because our individual stocks got triggered before our broader, more passive portion with the ETFs. So he's saying that, we start getting defensive before the general markets roll over. That is true with our individual stocks. And then the ETF, the big layer, 20, 30, as we hit the 21 exponential, 50 and more layers, we will move successively to more cash, and they're rules based. All right. So I just wanted to go over that. Next one. 422 KC. Good morning, Don. Quick question. When using the oversold Stochastic to get into positions, are you triggering on the 1 hour chart, 15-minute, or question mark? For an example, the ES had a nice oversold stole yesterday. This is on the 21st. On the 1 hour and 15-minute. Just curious. Hi, KC. I keep multiple time frames on my screen: 1 minute, 5, 15, 30, 60 daily. There's a lot of nuance involved, not a hard, fast rule. This is my comment. This is where playing the notes between the chords come into play and is a little more style. Hard rules keep you out of harm's way, meaning defensive stop rules. All right. Getting in, how you enter a stock can be more nuanced or more ways to enter a stock. Defensive selling is much easier. I'm not sure why more advisors don't do it. Unless, of course, you're really not the client. Are you the pie charts or us diversifier for their real clients? Just saying. Did you lose 20% just a month ago? Have you gone down that? All right, 2020, market was down 35%. We were down roughly 13. I'm just using round numbers. Okay. In 2022, bear 28.5%, 12. This time, 20 on the S&P, and we were down, 8.5, something like that, 9 maybe. It's an easier way to invest. But more importantly, even now on the bounce, we're going to underperform at the beginning because the way you missed out is you got in cash to begin with. So to miss the big drawdown, now we've got a big spread. So even if we wait a few days to get in to prove that this market has legs, it's sustainable based on metrics, it's still okay. We don't have to outperform the market every day or even perform with the market. Sometimes we will be opposite them, uncorrelated with the market's a technical term, and sometimes we're correlated. So with that, I'm going to bring the curtain back and let Don and the team tell us what they're actually seeing in the markets right now, what the market is telling you, because price is truth, no exceptions. Don, what's the market telling us?
Well, let's start off a follow-up to the pie chart comment. A lot of the quote-unquote diversified pie charts now are touting the merits of diversification because international stocks have been outperforming U.S. stocks this year. So they're joyfully mentioning that without mentioning that for the prior decade, there was massive underperformance by emerging markets and international against the U.S. stocks. So
2 decades.
cherry picking data there. But let's go to the S&P 500. We, as we point out every night in our videos, well, let me bring this graphic in first. How do you know how healthy the market is? Well, we know that we're in a downtrend. We know we're below the 200-day moving average. We've been talking about that, how we cleared the decks, went to virtually no exposure over the past 2 weeks. And then we put in a bottom. Well, what does putting in a bottom mean? How do you distinguish is the bottom into is the market fully bullish? And I have 9 steps listed here. And this is basically how we rotate from being fully defensive to being fully involved in the market. The first thing you have to do is regain the short-term 8-day exponential moving average. That is the purple line on this chart here, and that happened on 4/23. The second thing we want to see, so basically, if we're all below the 200, the 50, the 21, and the 8-day moving average, we want to be virtually have no exposure to the market. The first sign for getting back in is getting back above the 8-day exponential moving average on the indexes, in this case, the S&P 500. We also watch the NASDAQ 100 closely. Poked our head back above it and then had a nice gap up day on Wednesday to put some distance between the 8 and into the 21. So that was day one, regained the 8-day moving average, 423. Then on 423, we also failed at the 21-day moving average, and obviously that's a bad sign. So now we're stuck between the two of them, the 8 and the 21, very similar to where we were 2 weeks ago, stuck between those two. If we get above the 21, we put more on. We get back below the 8, we take more off, and that's what we did, regaining it. But after failing at the 21 on Wednesday, we regained it substantially with a lot of nice action from not only the indexes but from leaders. So that's number 2, regain the 21-day moving average. Also on the 22nd and the 23rd, we had O'Neill follow-through days, 4 or more days off the bottom. In this case, it was day 11 and 12. This was the first up day off of this intermediate bottom that we had. So not only did we get the follow-through day, we got back above the 21-day moving average. And then once you get that follow-through day, and if you have leading stocks participating, which we do now, we don't want to see any distribution days after the follow-through day. And so far, this has been especially the first 4 days after the follow-through day, because there's statistics that if you see that, the rally is more likely to fail. So we're waiting 4 days after that first, and no distribution. We'll be able to check another box on here from where we get from the bottom to where we're fully bullish. Then we want to see continued strength with the 8-day moving average crossing up through the 21. You can see if we continue to just even go sideways, that's going to happen early next week. So we'll be able to cross that off. And then we want to have the 21-day cross up through the 50. Long way to go for that. So we've got a lot of area in here to chop around. But before we finish that chopping around, there's a big level here right at 5,500 on the S&P, which acted as support when we were trying to break down twice before finally breaking on tariff day when Trump had the Rose Garden ceremony after the close. So that is acting as resistance today. 54.98 has been our high on the day, but that's great. We're basically 4 days off the bottom. And we're seeing the range tighten. That's also very good. And actually, I could add that as a 10th step on here. We want to see volatility decreasing. The average true range of the S&P 500 is over 3.5 right now, which is astronomically high.
Yeah,
a lot of it is just because of the 3 days in here, including the one day where we were up over 10%. But we're seeing that too. We're seeing the VIX drop. It's below 30 now. So volatility is decreasing. Perfect situation if you're bulls. We just go sideways for the rest of the day, maybe Monday, Tuesday, pull back a little bit. But this green line, this 21-day moving average, is going to catch up to price. We do not want to fall back below that, or we'll have to cross off one of our 9 steps because we failed at the 21-day moving average. And then we just recycle and start again. And all these things, you just check them off. And this is how you determine a healthy market from a risky market. Below the 200-day moving average, we're on record forever talking about how that's when risk is at its highest. And we very clearly saw that with this big move down in less than a week from where we tried to get back above the 200 and failed. Then the slope of the line rolled over, and then we dropped 12% in about a week on the tariff scare. But one day at a time, step by step.
Keep that up. Keep that up there for just one second. I wanted to mention it because Don's made some very, very good points, and he's really making a technical, mathematical plan for what if the market continues higher on strong volume, what if it continues lower on strong volume, what if it moves sideways. He's got all these scenarios gamed out and mathematically based on probabilities of previous markets, because patterns repeat. What is that? Now, he said all that math, but look at that lowest pink line. That's the shortest moving average. That's the very, very, very short term momentum. The green line is the next shortest momentum. That's the 8 exponential. And then you're going to start coming up to the slower, the reds, the 50, and the blacks, the 200. As those shorter term lines, the rate of change of the slope, you want to see those slopes angle up even higher, but you're going to want to, for a sustainable rally, that 50-day, that red line is going to have to start flattening out and then start hooking up. That's, like, see, Don's drawing that. That's how you're going to know. That's going to get confirmation, and that means it's bullish. That means stocks are going up. Therefore, that line has to turn up. It's going to start as soon as you see that start turning up. That's going to give you more confidence. If it rolls over, Katie, bar the door. And that's the way the math is working out in the lines. I just wanted to that's oversimplification, but I want people to understand those moving average lines, because those are a lot easier, I think, than the candles, reading the candlesticks or the other type of things on the chart. Anyway, one last thing. Don was talking about Europe being, weak. Look, emerging markets been dogs since 2000. So if you had pie chart with emerging markets 10%, you had 10% losing money for 20 years, it made 4% point to point, not even annualized. So 4% over 20 years. That means that portion of the pie chart was worthless. It lost you money. It was rotten fruit in your portfolio. Now, Europe is actually starting to heat up. So for the first time in years, Don in the robo-tection or the sector rotation portfolio, he got some Europe, right? So that's totally different than, and remember, if you listen to our podcast for the last 2-3 years, I've been saying, don't be in overseas. It's not, the risk is not commensurate. If America's the best place to be, that's where you should be. Price is truth, no exceptions. All right, Don.
Yeah, I just brought up a comparison chart here, Dan, of the S&P 500. This is a 13-year chart because the VXUS just started trading 13 years ago. But 13-year returns, 293% for the S&P 500, 41.4% for international, 2.5% for emerging markets. Over the last 13 years.
And that's supposed to reduce and think about it, with inflation, that means you lost money. That means you lost that means you lost decent amount of money, almost double digit. How does that help your risk? How does holding a downtrending asset for a decade reduce your risk? Tell me that, modern portfolio theory morons, please. Tell me how holding a downtrending asset helps. Rotten fruit is no good. You don't buy, I love Don's analogy. You don't go to the store and buy rotten fruit for a balanced diet. You only want the freshest fruit. Now, you want enough sectors so that one sector doesn't kill you. And so you want enough fresh fruit in different areas. So you want to balance, you want to get different vitamins and minerals, different cash flows, dividends, different growth, whatever. So you're going to spread that out, but you don't want anything that's bad. You want just enough so one Enron, one lying on the books doesn't kill you. But on the way down, you may not want diversification. You may want cash, and that's it. Anyway, all right. What's next?
So really, what we're monitoring is this 5,500 overhead level on the S&P, and to the downside, the 8 and 21-day moving average is coming up to meet price, and that will be our next big decision point. What happens when those situations occur? We're going to turn it over to Connor, who's going to talk about a potential leading group, not potential, one that has certainly stuck its head above water and screaming, "Look at me." We talked about this earlier this week in-house, and that's exactly what we've seen. Take it away, Connor.
Yep. Yeah, so indexes are strong off the lows, as you can see in what we've been talking about in the nightly videos, especially with the follow-through day. And then the next step is looking for what's the strongest stocks, what's the strongest group, and what are the strongest stocks in that certain group. And whenever there's a correction, there's always going to be somewhere, someplace, some stock that's holding up well. And we like to call those, a common phrase among traders is beach balls underwater. And one group that's standing out to me and the team is cybersecurity stocks. So on the screen right now, Don has a chart of Bug, and this is just a general cybersecurity ETF. There's also Hack, but just going to show Bug for this segment. And you can see technically wise, this is forming a nice double bottom base back above the 200-day moving average, and now it's coming into the 50-day. So, it is a little bit choppy, but that's just a function of the market. We saw a 20% correction in the Qs, and high beta tech stocks tend to correct more. So it's just the setup theme right now is these double bottom bases as a lot of things have pulled back quite a bit. So this is the ETF is looking constructive. If this can get back above the 50-day, handle out kind of what we're looking for across the board, that would be a good sign. But in terms of the leaders, some of the stocks are standing out and look much better than the ETF chart. And I got 4 cybersecurity stocks that I like the best, and the first one is CrowdStrike. And always in a sector, tends to be the number one liquid leader. For example, NVIDIA was always it for semiconductors. If you talk about Bitcoin, it's MSTR, and for cybersecurity, it is CrowdStrike for me. You can see relative strength line, new highs before price. That's very bullish. Broke through that $400 pivot. Again, very bullish with a decent volume as well. And this one's above all the moving averages, and it's showing great relative strength. So you have to ask yourself, if the market continues higher, this should spring to the upside even more. So this is clearly leading the sector higher, and as long as it can hold above 400, I think it's in great shape. Short term, it's a little bit extended, and we're still in the type of environment where it's a little bit harder chasing 2-3 days up in a row. So I think action plan for this one is just waiting for it to consolidate a little bit, maybe pull back on light volume, build a higher low. But for now, as long as this holds above 400, those moving averages could start to slope up, get a little bit better alignment. But nevertheless, this looks really good. One of the strongest stocks in the market, institutionally backed. Great composite rating, great EPS. So definitely like this one the most in the group. Second one is Zscaler, a little bit of a different setup. And the best stocks tend to break out first, but I'm not going to neglect Zscaler because this is a gorgeous base. Yeah, go to the weekly, multi-month, huge base. It's got a very clean level. If this one could take out 217 with volume, definitely would be a focus list in-house at Revere. And again, similar characteristics to Crowd. Relative strength line continues to make higher highs. prices above all key moving averages, and this one is just in a really nice tight consolidation. So if this one starts to break out, that'd be great for the sector. And then it could potentially start to move to the upside, kind of similar to like Crowd when it broke through that 400 level. That Zscaler. Next one is RBRK. And what I'm kind of trying to do with these 4 different stocks is each one's a little bit different. Now, RBRK, this one is a new IPO. So this is new merchandise. Crowd and Zscaler have been around for much longer. And you can see from IPO last year, this obviously had that huge multi-month base and then went on a really strong run, had a nice earnings gap, and then continued higher. But the general market started to decline, and nothing's really safe when that happens. So this came down with it as well. This one's got a double bottom base, although it's pretty deep. But I think that's fine given the severity of the market pullback. And this one's back above the 50-day moving average. So a little bit choppy for now, but that's normal in a young company. So this one starts to go sideways a little bit more or shoot up to 80, build a handle, plenty of scenarios. And then this is also above that high volume close from that earnings gap from last year. So that's RBRK, looks good. And then last one is OKTA. And this is another one that we were watching earlier this year and actually had a position in. This had that really monster earnings gap on huge volume, put in a day 2 higher high, and then pulled back to the 21, which is very normal for an earnings gap, shot back up, and like I mentioned, started to pull back with the market. And this one again is kind of choppy, but this one's trying to get back above the 50-day moving average. And if you go to the weekly chart, this has got a really nice stage 1 base. So if this one can get through that pivot level with volume, this one's got a lot of room to the upside, and especially with the other names in the group. And that's another main reason why we like to focus on groups, is because, stocks tend to follow the leader in the group. So of course you want the leader, but there's always secondary plays as well, like Zscaler, RBRK, OKTA. And most stocks follow the leader in the group, and CrowdStrike is definitely leading the way. And then there's a ton of other nice looking cyber stocks. Those were the 4 that I wanted to show. But if you just do a simple look at the top holdings in Bug or Hack ETF, you can find plenty of other ones that look pretty good. And then couple of general bull cases for cybersecurity in general is that, these names, everyone needs cybersecurity. So even in a tougher market, tougher macro environment, these could still withstand and do quite well. And then some other things is governments worldwide are introducing, a lot of people are amping up their security. And then the global cybersecurity market is forecasted to reach $300 billion by 2028, which is a compounded annual rate of 9 to 10%. So keep an eye on cybersecurity. Many of these held up near the highs better than most stocks during the pullback. Some are trying to break out. Some are still in big ranges, but nevertheless, these look like they want to lead. The market continues higher.
Does that look like an inverse head and shoulders right there? Is that not quite symmetrical enough?
A little bit, yeah. Kind of like the double bottom base. Maybe if it pulled back a little bit more, that would. But yeah, similar setup, definitely.
Yeah, and notice, let's go back to the S&P 500 very quickly and see how the S&P below the 200-day, the 50-day below the 200-day, and then look at the ETF Bug. 50-day moving average never got below the 200-day. We're all the way up to the declining 50-day moving average. Just massive relative strength going all the way back to mid-January in this sector. And that's what we're always looking, because you can't have a bull market without themes leading that bull market, and cybersecurity and software in general, definitely a theme that's jumping out at us right now. Great job, Connor.
And by the way, that is a gold nugget because the leading stocks, I mean, the first leader to's got to break out to actually to reveal the group, right? And so that's what Connor's talking about. As soon as you find the leader, then you quickly go into that group and try to find the ones that are just starting to break out. They haven't done it yet. because a lot of times the leader will be extended. Don, go back to that S&P chart again that you had up there. Because remember I was talking about the moving averages being over to the far right-hand side of the chart. But look there, folks. Look when we're above the 200-day, but even especially at the 50 on the most bullish. Just take a long-term look at that market. And when you see they're stacked evenly in kind of sequential order, the 200, then the 50-day, then the 21, then the 8, and they're done in order, that's the most bullish times of the market. When they get inverted or get mixed up or don't get in line, that's when they start breaking down. That's when you have the bear markets. If you look up there where that starts to happen, look at that. Yes, the 50 and the 200 are above the shorter term averages. The shorter term is breaking down. So short term momentum is overtaking long term. That's not a bullish sign in the short term. So you start taking defense. You start raising cash. If that continues and momentum builds, selling begets selling, you raise more until finally you're just out. And then just on the flip side, once you bottom out, when the shorter term averages start hooking up, you need to start adding exposure. If you wait to get to the 200, it'll be too late. Don always gives you the stats that when the monthly average return when you're below the 200-day is negative 2.6%. Yes, that's true. The problem is the first month is 15 or 18%. The next one's another 10 or 15, and now you're down 35 in the first couple months. That's why you have to have a sell discipline quick in advance, because the big losses happen in a month. Do you have a plan for 2 weeks or a month? Is your advisor? Ask him. But then after that, you'll have a month that's up 3% or 6% or 2%, whatever. All I'm saying is the next 5 or 6 months is working its way off the bottom. You can have positive months in there. It's really the two huge big months at the beginning that are the most dangerous. You got to have a plan for that. Anyway, go ahead, Don.
Yeah, and this going from bottom to bull just works completely in reverse when you're going from bull to bear. First, you'll lose the 8-day moving average, lose the 21-day moving average. You'll see a bunch of distribution days. The 8 will cross below the 21 will cross below the 50 will cross below the 200-day. It's just...
It's a mathematical chart. It's what it is. It's a mathematical chart.
Yeah.
Yes, that's math in a chart. That's what that is, folks. And it's still probabilities. It can change. And that's why we always say it's okay to be wrong. It's not okay to stay wrong. By the way, this kind of reminds me because this was a very quick bear market. This reminds me of the COVID bear, where it was basically artificial. They shut down the economy mechanically and then realized they were killing it too much quickly. And so they spent $4 trillion in funny money and turned it back on, right? Right before that, Don did 3 videos. So in January, right when the market was at the top, it just happened to be apropos. He didn't know the market was at the top. He was just saying, how do you avoid the next bear? I can't remember the exact name of that one, but it was
Stay clear of the bear with Revere.
Yeah, stay clear of the bear with Revere. And he talked about how do you time how will you know when the next bear market is coming? And he looked at all 13 bear markets since like the 60s, right? And he went over those. And the market sold off like literally that next month. It just happened to be timing. And he did one when we were kind of halfway down and then he did one after it bottomed out. And it said, and that one was called the bear market recovery plan. In other words, how do you recover off the bottom? Because it gets choppy normally, not in 2000, but 2022 inflation, that's a real bear market recovery, right? Anyway, he shows that. And then, so he did 3 videos all within 3 months. The reason those videos are so apropos is it was one complete bear bull market cycle all within 3 months, which is very unusual. So you got to see all that, how to manage before the bear rollover, how to sell out, then how to get back in, and then how to manage in between. It was just anyway, if anybody wants those, just reach out to me and I'll send you those. You can watch them in sequential order. Anyway, go ahead, Don.
All right, we've got another potentially emerging theme, and Ted's going to talk about that now. He's going to do a deep dive on Uber.
Yep. Thank you, Don. So when looking back at all my best trades, they've usually been names I've stalked for a while. and Uber is definitely one of those. And to me, it's potentially, and I say potentially because we do need to see a breakout ultimately, but I think it's a potential fat pitch in the making. And we've started a position in Turbo, and we'll look to build into it as it works. But it is my personal favorite liquid stock in the market right now, and it's for just a whole list of reasons, which I will go through in this segment. And so I guess I'll start first with some fundamentals, and then we'll bring it to the chart and talk about the technicals too. And that's usually the best trades when the technicals and fundamentals blend together. And pretty much my thesis, I mean, Uber is a household brand name. I've used Uber for years now, and I find myself, Connor as well, like on the weekends, we'll use it multiple times a week. And I mean, there's that saying that when a company's name becomes a verb, Uber, that is one of the greatest indicators of a great business, and especially the wide moat of a business. And
Q-tip.
for example, you think of search, you think of Google. Well, that might be changing a little bit with some AI platforms, but when you think of e-commerce, you think of Amazon. When you think of cola, you think of Coke. When you think of Mexican food, you think of Chipotle. When you think of video streaming, you think of Netflix. And so when you think of ride sharing, now you think of Uber. And I think that's really important for Uber's brand, and it's just global dominance. So just some other numbers, it completely dominates currently the ride sharing market with 76% market share of the US and 25% of global ride hailing. And that includes the taxi market too. And I think what's more important is like what I talked about, how it's a verb now. And there's a term called mind share, not just market share, but what people think of when they think of a particular product or service. And in this case, ride sharing is almost synonymous with Uber. And I mean, really, you look at their main competitor, which is Lyft right now, and looking at historical trends, they continue to grow against Lyft or hold steady against its competitor. And Don, if you pull up Lyft's chart real quick, you can see the drastic difference between these two charts, and it reflects on the fundamentals as well. So yeah, like I said, I use the service nearly every week. And recently I was in New York, and for the first time, I didn't know about this before, but my friends up there told me to use the Uber shuttle from LaGuardia into New York City. And it's often cheaper because it's a pretty much one of those black Mercedes Sprinter vans that pick you up at a main destination, which was the airport, and then dropped me off at Penn Station or Grand Central. And then I took another Uber to my final destination. And it definitely saved me at least $30, $40 on the entire trip versus just taking one single Uber from LaGuardia into New York. And it was extremely seamless as well. No issues with it. The check-in process, when the Sprinter shuttle comes, they scan your app and then you just get in. And it was a great service for me. And back to the Uber verb name, like when I reflect on growing up, I wish I knew about the financial markets in my early childhood, because I grew up during the boom of the likes of Google, Amazon, Meta, Facebook, Instagram, Apple, Netflix, Chipotle, and more. And so I think Uber has that potential to follow in the footsteps of many of these household names, and definitely increase its market cap from its current point, which is about 120, 130 billion right now. And really, I mean, yeah, especially in cities, you don't have a car, or see myself using Uber more and more. And so continue on. Another great proposition from me, at least with Uber, is that it combines growth. It has nearly all the CanSlim factors, and I'll go over all of that. But it's also undervalued at the same time. And we don't talk about valuation that much, but when it has the growth and it's undervalued, plus the chart is setting up, that to me you just have all the factors aligned, and that could lead to a really great opportunity. So right now, the current PE is about 16.8 times earnings, and last time I checked, the S&P was trading at 26 times earnings. And with triple-digit growth in the last 3 quarters, at 154%, 1,020%, and 384%, and then moving from 40 cents to a whopping $3.21, I think this is just displaying like wonderful growth. And it's really a testament to the new CEO who came in 2017, like turning around the business from a money losing business into really a cash generative business now. And so when we go on looking at the revenues, it's also accelerating 16, 20, and 20 in the last 3 quarters. And then if you look at the annual revenues, it made 17.5 billion in fiscal year 2021, and now it's up to 44 billion in fiscal year 2024. So just great growth in both earnings and revenues. And when we talk about like the management, Dara, I think he's a great CEO, and just the way he came in and turned this business completely around, it just shows his operational capabilities, and he really has scaled the business and made it efficient. And that is really evident in its gross profit acceleration as well in the last 5 quarters. And MarketSmith doesn't have, I don't think it has the gross, I think it does have the gross profit in the last 5 quarters. And it also had huge net margin profit expansion as well. And then its return on equity, which is a pretty good financial ratio that William O'Neill used in CanSlim to determine a company's efficiency and quality. It has rapidly grown from 30.68% in Q2 2024 to a huge 141% in Q4 2024. So the earnings, the sales, the return on equity, all part of that very strict CanSlim criteria. If you're going to follow it by the textbook, has all of it. And then right now it's currently in a 1-year base, and the base started around February 2024, and it's continued to base into 2025. And throughout that time, they've only grown earnings and revenues as well. Fund ownership has increased as well, if you can show that. And I'm pulling this from DeepView data, so it might not be the exact same as MarketSmith, but we saw fund ownership increase from 2004 to 2,531, which shows significant institutional accumulation as well, up about 20%. And then just finally, like some other points, a huge potential way to expand their business. And today they announced a news with some European autonomous vehicle company that they're going to start deploying those in California. They could also potentially partner with Tesla, but I think Tesla recently, or in January, denied a potential partnership proposition because Elon's known to just vertically integrate their whole business, and they kind of have set up an app on their own. But we'll see what happens between Tesla and Uber. Uber still dominates the global market for ride sharing. And if Tesla wants to break into that, it could be potentially helpful to partner up with Uber. So onto technicals now, Don. If you pull, let's start off on a high level. If you pull up a monthly chart, Uber IPO'd in 2019, so about 6 years. And historical studies show that the biggest movers are IPOs within the last 10 years. So checks that box. And really, so far in the last 6 years, it hasn't gone really anywhere since the IPO opening price, up like 70%, but that's nothing for a growth leader. And right now, the chart pattern we have is a base on base. It made a 300% move from 20 to 80 in this recent bull market. And instead of going through its normal stage 4 correction, it did briefly enter stage 4, but it held in there and continued the base sideways for a whole year. And at the lows of the base, we see multiple undercut and reclaims showing support, buying support. And if you look at the monthly volume, the uptrend saw huge blue bars, blue skyscrapers of volume. And then during the basing process, you can see volume dried up significantly. And then recently in this more recent action, if you can go on the weekly now, you can see there's accumulation as well as more undercut reclaims of some key levels, especially in the more short-term price action. You can see like the up volume weeks are much higher than the down volume. So that is some more higher level characteristics of Uber. And now, Don, if you can go on a daily chart, this is where it really started popping on my radar and why I did more of a deeper dive into Uber. Recently, as we know, S&P fell 20% and the Nasdaq fell 25% from highs to lows, and Uber only corrected 26% from its recent highs to its lows, which for a growth name is very reasonable. As we know, the typical growth name corrects 1.5 to 2.5 times the general indexes, and Uber corrected about 1 times. And then so far as indexes have lifted off its recent lows, Uber has really just bounced back like a tennis ball. And we've talked about that saying before on the show. We want to see tennis ball action in names where they bounce back quickly, and now it's within 10% of a new all-time high. So that's a very attractive feature of Uber right now. And we started some name yesterday. It did break through a flat base pivot around 77.6. That was an add point And then really the next final add point is 82.2. And another option is just accumulating against rising moving averages as well. And so it has earnings May 7th. And as we've seen and studied stocks in the past and highlighted on the show, a lot of times a huge earnings surprise or some huge guidance raise or some other news in earnings reports can send a stock from a huge base into a stage 2 uptrend. And so that is what I'm currently looking for from Uber. But it's shown a profit right from the start since we bought it, giving us no pressure. And that's often a characteristic of our biggest trades as well. And then Don, I just wanted to do a quick segment on Bitcoin as well. I wasn't planning on it, but it's also forming a great weekly base. If you pull up IBIT, the prices won't match the Bitcoin spot, but this will work. As you can see, when the markets really crashed, it was up there with Black Monday, COVID, and the Great Financial Crisis in that 3-day crash. Bitcoin IBIT held a rising 200-day moving average and a rising 40-week. And instantly that caught my eye. And it held price structure as well. If you could draw that huge line back across that pre-election breakout level.
And look how the moving averages are stacked.
Exactly.
See how they were inversely stacked on the way down, and they're stacked the right way on the way up.
Yep. And Bitcoin's back above all key moving averages right now on Don's chart, which is amazing. And we're 5 days up in a row. And right now, just looking to see if we can build a right side and look for additional entry points. But Bitcoin, I'm extremely bullish on once again. I mean, the chart confirms it. It held previous breakout, turned support, and this is just perfect price structure and price action with the volume as well. And just some other, I guess, miscellaneous points about Bitcoin. We recently saw the Federal Reserve Board remove some regulations off banks, and now they don't have to report crypto activity. So maybe banks will start accumulating some crypto. Who knows?
All right. Did you want to take the screen and show something else?
Oh, yeah. One last thing about Uber. Let's go back to Uber. So I'm going to take the screen real quick, and I just want to highlight another reason that makes us more bullish, or makes me more bullish. So everyone probably knows Bill Ackman. He's one of the best value investors in the world. And when our growth style plus a world-class value investor plus the technicals match up, this is more of a qualitative observation, not quantitative. But this makes me really bullish. And he had some great thoughts to share about Uber, him as a long-term customer as well, and a lot of compliments on the CEO. And oftentimes when you have great management, that can drive great returns for a stock too. And just one last thing I want to point out, they had a quick little conversation. And when you see a CEO be this responsive, especially on social media, and take constructive criticism, that's always a good thing, and someone you want to back your money with. So that's just my final points on Uber. And you can find this on Twitter as well if you search up Bill Ackman.
Yeah, he's a good follow.
All right, good stuff. Dan, that's it from the tech side. You can take it away.
Folks, listen, if you're tired of the pie charts or us portfolio where you're making 6-7%, you're losing 25-35% we've had the market, not us, not Revere. We've never had a bear market in Growtection, but the S&P's had 3 bear markets in the last 5 years. We hadn't had one. And we're pretty much matching the S&P. We beat the S&P last year, 25.6. We didn't have breaks. We had breaks, but you didn't need them. You didn't really need them that much during 2024, but we had them if we needed them. We did need them in 2022 and 2020. So you've always been told that to make higher returns, you got to take more risk. And we're kind of showing that you can make market-like returns with much less risk as measured by drawdown. When the market hits a bear market, we roughly go down generally about a third as much. It's a much easier ride. Folks, if you want a better way from the pie charts or us crowd, just go to revereasset.com. Up in the right-hand corner, there's a contact us button. Shoot me an email and tell me you want me a complimentary portfolio review, or if you just want a stock or a topic talked on the show, we'll put it in the mailbag. Next to it is our subscribe button. You can put your name and email address in there, make sure it takes, and then you'll get our daily market insight video every night. And every night the market is open, we do one of those videos. So we are updating you every day with a short video on our thoughts on the market. We're most a transparent fiduciary advisor, not in the United States, in the world that I'm aware of. I don't know any other advisor that's putting out what they're doing every day on a video for you and our loyal stock nerds. Okay. Then we do this podcast, and I put this out. We're recording it Friday morning. Zach, the producer, puts it out on YouTube. If you just go to YouTube and just go to Revere, just type in Revere Asset and hit subscribe, our stock nerds get this a couple hours before the market close on Friday. But on our newsletter thing, it'll come out Saturday morning. So that's why you subscribe to both, because sometimes it comes quicker on YouTube, sometimes it's quicker in our email blast. But either way, it's the same, and we don't take down anything. Our videos go back years. So if you really want to do some due diligence, sure, you can go to our SEC compliance stuff, but really, you can go look and see what we were saying right before the COVID bear telling you to move to cash, or the inflation bear, or even just last month, what we were telling you to do while the market was melting down. Folks, if you want your money to look like our money, our family, my money, Don's money, same exact timestamp, same exact price, same exact performance tracking, then just come to Revere Asset and dump the pie charts or us. You can always call us also at 855 Real Wealth. We'll talk to you next week on your money, not their money, your money.
Because it's not how much you make in the market, it's about how much you can keep.